Good morning, Richard Calhoun, real estate broker with Creekside Realty for 40 years, serving buyers and sellers here in Silicon Valley. We're here to talk about the real estate market in the past week. This first graph shows what I call the macro data. Macro data is Santa Clara County, San Mateo County, single family condos and townhouses. The yellow line is the 5-year benchmark. The 5-year benchmark is 2015 through 2019. So those were 5 great years. So if the data, which are the 3 colored lines, were right on the yellow line, we'd be completely normal. To the right side is 2020. To the left side is 2021. During 2020, you do have to subtract 1 to get the correct week number, and that's to create this observable gap when we're changing from one year to the other. So what we're looking at is inventory. So inventory in that whole macro market now is 80% of what you'd expect it to be, 80% of the 5-year median. Earlier this year, when everyone was complaining about the lack of inventory, we actually had a surplus of inventory 40% above. Then for a fair number of weeks, about 8 weeks, we were at normal inventory. And then basically starting in week 16, we dropped down to below normal level of inventory, and we've been below normal level of inventory ever since. The other gray line, which is gray because it's less significant, is the number of new listings that are coming on the market every week. And you can see that there's some fluctuations. This spike happens to correspond with Memorial Day. This spike happens to correspond with July the 4th. This spike happens to correspond with Labor Day. That's just the way the calendar works. Basically, July 4th was as late as it could be this year. It was on a Sunday. Labor Day is on September the 6th this year, which is about as late as it can be. And so we had more inventory because sellers tend not to put their house on the market going into the holiday. So this is just a weekly fluctuation here. But long term, what you can do is you can see the gray line is about where you'd expect it to be. So we're getting the same number of new listings on the marketplace as we normally do. So sellers are selling at the same rate. So this concept that sellers are fleeing the area and everything else, simply not accurate based on the data on the MLS. Sellers are coming on the market at the same pace that they normally did in 5 years in 2015 through 2019. Now, the other side of the supply demand curve is the demand curve portion, and that's the red line. That's how many offers have been accepted in the last 5 weeks. That's what my benchmark for measuring demand. And you can see demand has basically been above 20% above the 5-year median. So that's the real story. We're having a surplus of demand at 20% above where you'd expect it to be. And if you have excessive inventory in your reservoir and you have excess of demand, eventually that reservoir goes down to normal. Then eventually that reservoir goes down below normal. And that's exactly what's been happening. So it's this red line, the demand side, that is causing our supply demand imbalance, in my opinion, because the new inventory, the new listings coming on the market is exactly where you'd expect it to be. The reason existing inventory is below where you'd expect it to be has been this whole long-term, over a year-long period of time where demand has been above where you'd expect it to be. So that's my opinion, and I think I back it up with the data. Now we move on to the supply-demand ratio. That is the ratio of the 2 data points we were just looking at. And so the yellow line is where you'd expect the data to be. I didn't do it on a percentage basis. I put it on real value so that you can see the same data printed, plotted differently. So you'd expect the inventory to be somewhere around 38 days of unsold inventory. In reality, this year, we're down here somewhere around 21, 22 days of unsold inventory. That's a pretty significant difference. Anything below 40 days, I consider to be a strong seller's marketplace. From 40 to 80 days is white, which is a balanced marketplace. And when we are up in a buyer's marketplace, it's more than 80 days of unsold inventory. So you can see we've been basically normal last year at the end of 2020. We started off essentially normal at the beginning part of this year, 2021. And then basically starting at week 16, all of a sudden the market is normally slowing down. And here our DUI this year stayed perfectly flat. Now, again, this spike here is just a spike, as you can see, because the data came right back down because July the 4th. I expect a similar spike coming up because this is the week there won't be any inventory coming on the marketplace. Therefore, there won't be any sales. That will cause the days of unsold inventory to increase. This graph is completely different. This is flipping over to the buyer's side. How much pressure are the buyers feeling to overbid? Seller has their asking price. Is this buyer paying more than that or less than that? And this is each line represents a week worth of data. Our best line is the red line up here, which was April of 2018. Our worst line was down here in December 2001. So basically, we're in the middle. We're towards the upper end of the middle. But what becomes more interesting, and we'll see this a little bit later, when you look at this, the red line is the direction of an improving marketplace. What happened is we started off down here, and then we improved and improved and improved. Then we turned around and we returned down, and actually we're getting to be a less great marketplace. And then we turned around. In the last several weeks, we've improved again. So if we look at the worst line on here is this dotted orange line that's almost hard to see down here. And if I was to guess, that was probably April 3rd of 2021. And that's basically right after Cesar Chavez holiday. So that might have something to do with it. But basically, that was when the buyers felt the least pressure in the last 22 weeks. Now, if you come up here to the peak, you sort of have this blue dotted line, which is sometime probably around May the 8th is up there. But then you also have some other lines up here, the dashed green line, which is hard for me to tell, but probably somewhere around June 12th or something like that. So that was sort of the peak of the market, the end of May, beginning part of June. And then the market slowed down. And then here, this solid yellow line here is the less orange of the two, more of a yellow, because here's the more orange one. So the more orange line is right here. That's August 21st. That's last week. Then basically, it's hard to see. 2 weeks ago, the 14th is this gray line. And 3 weeks ago was the 7th, which is this yellow line. So basically, the market came down, it was down here, then it was here, then it was here, and then it was here. So it's basically improving again. So the buyers are feeling more pressure to overbid. So how do you read this graph? Basically, where it's horizontal at 100%, those are the transactions where the seller is getting exactly their asking price. Then up here, this is the percentage of the sellers that are getting more than their asking price. So on this dotted light brown line, basically something like 70% of the sellers were getting more than their asking price. All the way over here on the left-hand margin, this is the 5%. So 5% of the sellers are basically getting 25% above their asking price, which is pretty significant. Now, if you go back to the best month, April 2018, 15% of the sellers, and actually it's probably closer to 16 or 17%, were getting 25% more than their asking price. So you can see the difference that the concept makes. This now is my appreciation chart. I am using the base year, which is the whole 2020 calendar year. So every transaction that was reported closed on the MLS from January 1st, 2020 through December 31st. Then I took the median value for the different micro markets, and this is the percent appreciation since that value. The yellow numbers are the highlighted numbers of the peak of the marketplace. So you can see for the most part, right here at the end of June, beginning of July, we had sort of the peak pricing. But remember, in order to get pricing, the peaks happened 5 weeks earlier than that because of escrow, and then 5 weeks before that. So it was basically 10 weeks before this when the market conditions peak. That's the quick recap. I'll pause, see if anyone has any questions. And if no one has any questions, I'll go forward. While we're doing that, this is the root URL that will get you to the YouTube channel where these are all archived. If you put in the 4-digit year code, you'll get to the live meeting Saturday morning. If you add the word handout, then you get in the specific 8-digit year, month, date code, you get to the handout for today's slide. It is not yet posted. It will be posted when I upload this, probably on Sunday, because I have a pretty busy schedule. And to get to the archive of a particular session, you put in the base URL and the 8-digit year, month, date code, dropping out the word handout. Not seeing any mics unmuted. I will proceed. This is looking at the major components. So we have DUI, which to me is the most significant. The reason it's the most significant is there's not a lag time. You don't need sale price. All you need to do is have offers. So it's still a lagging indicator because you need 5 weeks worth of offers. And what I have is last week's data and this week's. So you can see there's really no huge improvement. It's basically the same from week to week. If the market was shifting, the magnitude of numbers I would expect to be doing is increasing or decreasing by about 5 to 7 days of unsold inventory every week. So we're nowhere near that level. The biggest one is probably down here. So base only the base cities, condos and townhouses, and you're talking about a change of less than one full day. I don't see anything that's more than a full day. So that's a pretty stable marketplace. Really no flux. It's basically fluctuations. There's no shift in the marketplace. Then we're looking at the frequency of overbidding in the different areas. You can see we go from the lowest of 70% of the sellers getting more than they're asking to the high of 74% almost getting more than their asking price. Then you're looking at the magnitude of overbidding. The magnitude of overbidding goes from a low of 104% up to about 110%. So actually 111%. So that gives you a pretty good idea of what's happening in the different micro markets on the what I consider to be the three most important data points. So this is total active listings that are available for a consumer to go off and buy. It does not include any ones that the listing agent's seeking a backup offer because the consumer can't actually buy those transactions without the first buyer backing away. So the numbers that you're looking at as the top line is the previous week and the bottom line is the current week. So again, you can see that there's only been a shift of 30, not a big shift considering everything. You can see single family homes went down 20, condos and townhouses went down 10. They actually went up in San Mateo County, so they came down 16 in Santa Clara because the two counterbalance each other. The same concept happened in single family homes where in San Mateo County, they went up like they did in the condos and townhouses, and in Santa Clara County, they went down. So basically the demand's been stronger in Santa Clara County than San Mateo County, and it has been even before the pandemic, but that is a fairly new shift, but I believe it's related to the companies moving south and east over periods of time and, people not necessarily willing to pay the premium to be in San Mateo County any longer. Then you're looking at the number of offers, not this week versus last week, but 1 week versus 5 weeks. 5 weeks is what I base my decisions making on. 1 week is just to give me sort of a hedge factor of what's happening. The major negative of 1 week is it's just too much fluctuation. You can't tell a statistical fluctuation versus a change in the marketplace. And that's what the advantage of 5 weeks does. And then you come down to the all-important DUI, which is the ratio between the two. And you can see, the 22 is the lowest in the 5 weeks. So Santa Clara is actually improving. It went from 22.1 to 20.5. If you want to look at it, San Mateo County actually went the other direction. It went from 26.5 to 32. So they're going right now, the two counties are going in opposite direction. But again, that's when you're looking at 1 week, which is a lot of fluctuation, which is why I don't tend to look at it. And that's why, the red is the lowest number. So that's Santa Clara County single family. And then the highlighted is sort of the blended. So here you have the condos blended. If you're looking for a condo, you can look at about 30 days of unsold inventory. The reason it's close to the 29 is Santa Clara County has larger volume of units. Same concept that was condos, same concept with the single family. Combined is 23. You have 26 and a half and 22. And when you combine them, the whole market overall, you end up at 25. So you're basically doing a weighted average instead of just a straight numerical average. Now you're looking at the days of unsold inventory, since I'm saying that's the key over time. Here is when the pandemic was announced, basically back on March the 17th. Here, and it might be a little bit hard to see, there's a tick mark here, which is August 21st, 2021, but there's one more tick mark. So this is data right up last night at midnight, Friday night, midnight. And you basically can see we're fairly flat looking. We sort of, where did you go flat? You could argue you rolled over here and then you basically climbed a little bit. Condos and townhouses, the yellow line definitely climbed and then it came back down. San Mateo County has sort of been more stable. It climbed coming out of the month of July. The market slowed down a little bit and then it's basically been flat since. But even though these are flat, and then this on the red up here should be down between 40 and 80. I need to make a note. I went looking for this slide because I got caught on it last week and couldn't find it. So this is the one I need to go find and move it down. But basically when you're below 40, the red line should start here. The red shading should start here and go down. All three micro markets are in a very strong seller's marketplace. So now you're looking at the heat map. This is single family homes only. And you can see the range, the whiter the color, the slower the marketplace, 68 days of unsold inventory. The fastest market marketplace looks like it might be down here in Foster City at 11.7. So that's a pretty small area. So what I would probably do is give the fastest large geographical area to the affordable areas of Santa Clara County, the moderate affordable areas, Milpitas, North Valley, Santa Teresa, Blossom Valley. So that's sort of a split micro market, fairly similar type homes, fairly similar in price, and they're getting blown out in just 12 days. And it's hard to get much below 7 or 8 days because most of the sellers want to expose their property for a weekend. Now what we're doing is looking at total active inventory of the macro data, and you'd expect it to be on the yellow line. You can see last year you were on the yellow line, then we had above normal inventory all last year and the beginning part of this year. Then we had exactly normal inventory, and it only was starting basically in week 16 of this year when inventory normally increases, and it's basically been flat. So we've been falling below and getting below normal amount of inventory. Number of new listings, exactly what I said earlier, the blue line, the data line, is essentially exactly on top of the yellow line, the 5-year median. So you're having exactly the number of new listings coming on the market every week that you would expect. Now you might argue with me that, hey, this week's up, but Labor Day weekend is now coming up on September the 6th. So it's quite a bit later than it typically is. It can be one day later. It could be on the 7th, but so a lot of those 5 years are probably Labor Day fell on the previous week. Now you're looking at the number of offers accepted. And again, consistently, you've had more demand than you typically would expect. Not hugely more back here. It's the vertical separation getting to be more here. Right now, picking rough numbers, you'd expect to have something like 420 new offers. And in reality, we had probably something like 550. That's an extra 130 transactions based on a 420. That's right at that 25% number that I was quoting earlier today. Now we're looking at the number of closings. Nothing really you learn here except that it's the number of new offers delayed by about 5 weeks because of the length of escrow. So it really doesn't tell you anything new. Now we're looking at the frequency of overbidding over time. You can see that last year when people thought we were doing good, sellers were getting about 60% of the sellers were getting more than their asking price. That's where we started off this year. Then we started to climb and we got up here around 80%. We hit almost 88% up here. Then we were back down to 80%. And right now we're back up at 85%. So clearly this is sort of the peak of the marketplace right around the end of June, because that's going to be like week 26. That's, basically halfway through the year. And so because you need the sale price to get frequency of overbidding, this peak actually happened 5 weeks earlier. So you go back 5 weeks from the end of June and you're at the end of May. That's traditionally when the market peaks. What's unusual this year is it's basically been staying up instead of cooling off a little bit. I think it's a lot of the buyers that have been frustrated from earlier in the year are taking the normal slowdown in the marketplace and keeping it from happening. This is the breakdown of the 3 micro market areas. So condos in Santa Clara County, San Mateo County, single family homes, and single family homes in Santa Clara County. Now this graph, to me, it's partially because it's blown out on the scale a little bit better. And this is the frequency of overbidding versus DUI. So the frequency of overbidding in San Mateo County is clearly increasing. You're back here in the middle of June, you were some number around 75%. And now in the middle of August, you're at 85%. That may not sound like a huge increase, but you're never going to get to 100%. So going from 75 to, getting 25% of the sellers getting less than their asking price to 15% less than their asking price is a pretty significant change. Because I also am not counting the roughly 5% of the sellers that would be getting their asking price. And in Santa Clara County, you can see it's been flatter for a longer period of time. It hasn't had the climb like San Mateo. So San Mateo County has caught up to Santa Clara County. This is the frequency of overbidding in the map form for you. So you can see the different numbers and the color coding. So the redder the color, the more frequent overbidding is. You can see the San Mateo border communities, the rich ones, Menlo Park, Atherton, Woodside, and Portola Valley are basically the area that's getting the least amount of overbidding. And here's the overbidding on a time graph. Last year on the right-hand side, 2020, you have to subtract off 1 week. On the left side is 2021. So you can see right now, sellers, the overbidding magnitude is somewhere around 108%. So sellers on average are getting 8%. That includes the ones that are getting below their asking price. This is the magnitude geographically. You can see the different color schemes. It's actually noteworthy. I guess this is the whiter color. This almost looks like Redwood City and the Atherton areas are almost the same color. So 105.2% versus 106. So yeah, they are. It almost didn't stand out, but this color here for Redwood City and this color here look the same. And when you come over here, you can see that, they should look fairly similar because their numbers are pretty close together. And the coast is sort of that same area. So you have this big swath of properties that are all at about 106% of overbidding. This is a new table. I would appreciate feedback on people, whether they like this or not. I don't know if I'll continue it for these different areas, but what you have here is the color code for the three major components: days of unsold inventory, frequency of overbidding, and magnitude. So the redder the three components are, the stronger the area are. So if you look at South County, they're pretty strong on DUI and frequency, but they're pretty weak on magnitude. So even though it's a hot marketplace, the buyers down there aren't really overbidding. Sort of the hottest community, just looking at this quickly live, is Cupertino Sunnyvale. It's really hot on DUI, it's hot on frequency, and it's hot on the magnitude of overbidding. So you can pick your micro market and sort of get a quick view of all three major components to understand what the market is, as well as the numbers. So I just thought that was an interesting table, so I put it out there. You can go back and look at this online. We already discussed this graph. I bring that one back up to look at this one. So now you can see the color separation a little bit better. This is only the last 12 weeks. So here you can see now this brown line. It was in fact July the 10th. You got a dotted line right here. It's hard for me to tell which line it is. I would bet you it's July the 3rd. And then you come back to the solid lines, the most recent ones, and you can see the most recent one is right here, this dark orange. So the dark orange and the purple are essentially on top of one another. Here the purple up on the top end, the purple's outperforming the orange. Sort of in the top quadrant, the orange and purple are on top of one another. Here the purple is outperforming again, and then basically in the bottom part, they're basically on top of one another. So this week to last week, it's not really any different, but the 2 weeks before that, the gray line and the orange line were on top of each other and significantly lower than the purple and the orange. So that can sort of show you that the market was improving, going up to the right, and then it turned around and went down to the left, and now it's turned around and gone up just a little bit, indicating the market's starting to heat back up again. And again, that requires sale price, so it's lagging data. This is the median price, and then I also do the 10 percentile, the lowest homes you'd expect in an area, as well as the 90 percentile, the highest. A lot of statisticians do the quadrants, so 25, 50, 75, but that would say that only half the homes are between the numbers. By doing the 10 and 90 percentile, I now get to say that 80% of the homes are between these numbers. And what's interesting, and it's pretty consistent through here, the difference between the 10 percentile and 50 percentile is about 1/3 of the total value difference. So you have the value difference of about $1 million between the 10 percentile and $1 million. So you'd expect the difference here to be about 300,000. So you add 300,000 to 830 and you're at 1130, and you'd expect a little bit higher. In fact, if I did the math, it would be 1163, I think, and you're at 1180. You can't get closer than that. So, I noticed in a lot of areas that ratio tends to make sense, and it makes sense physically because there's more properties tends to be at the lower end. So half the properties, you only go through 1/3 of the price range, and then the other half of the properties, you take up 2/3 of the price range. And when I say half, it's really only 40%. So for example, in South County, 80% of the homes are between $800,000 and $1.9 million. Now what we're looking at is basically the 5-week data starting at the first of the month and going for 5 weeks. So you data for right here, this is August data. So it started on August the 1st, and then it went for 35 days. Now, historically, way back here, I was doing the calendar months. So, these months back here are for the month of August. Then I shifted to 5 weeks, starting at the beginning part of the first full week in the month, to not include the end of the previous month, because that tends to be very lopsided unless it was the holiday, because that tends to have very few transactions. So it was basically confusing for people on my definition. So then I changed to starting on the first of the month and going for 5 weeks. And that makes a very simple definition, and that's what I'm using, except for the current year, because if you started on August the 1st, you can't go for 5 weeks yet. So here I stop on Friday night night at midnight, which I thought was the 27th. Oh, that's when I get the data. So I get the data on the 28th. So I stop on the 27th and go back 35 days. What the purpose of this table is to give you something to compare it to on where you think the market's going. So inventory at 772, and generally I'd be expecting inventory to be going down. The holiday coming up, and the holiday's always there. So even though we have a little bit more inventory than we do in 2017, by the time we get to 35 days past August 17, I would not be surprised that this is a record low. It will at least be a lot closer, or my prediction is it'd be a lot closer to the 723. The average days on the market for what's selling, 17 days and 9 days, all-time record. Never have I seen numbers that low. The closest again is back here in 2017 with 21 and 11. Now, last year you were at 20 and 9. So, last year you had a strong marketplace, but we're stronger now. And the reason we're stronger, the reason the average is down, is it's harder for a seller to be on the market for a long period of time because the market's so aggressive. Buyers are willing to go in there and try anything to get a house. Then days of unsold inventory at 22.1, not significantly different than 22.4. Same order of magnitude. Clearly, sales per day at 34, I think this says 34.9, 34, call it 35. 2017 was 32. Generally speaking, the peak number of sales happened the 5 days before, or the 5 weeks before Memorial Day. So I would expect this number to come down a little bit. I don't think it's going to lose 100 because we only have like a week left to go. Time will tell. Overbidding really doesn't change that dramatically. And you can see you're at 108.7% versus 106.7, 82.4% versus 74.4. So you can see, even though 2021 is somewhat similar to 2017, 2021 appears to be outperforming in the terms of being an aggressive marketplace. Then you have the 10 percentile, the median, 50 percentile, which is the median that most people follow, and the 90 percentile. So you can see you're up a lot year over year. We're up a whole ton from 2017. We're up something like 40%, at 45%. We're not quite 50%, but we're getting close to 50%. So we're probably at least 45% up in just 4 years. That's pretty incredible. And then this is going back in time. And look, the reason I say I'm going back in time is the last month I have complete data for is July. So these allow you to do apples and apples comparisons. And I will probably come back and update some of the volume of transactions. And with that, I'm finished for this week, unless I have any questions. So here's the URLs that you can take note of. Feel free to reach out to me, and I'll pause to see if anyone has any questions. And if not, we'll meet again next week. All right. Thanks for joining me. Take care, everybody.